Join me as I dive into the unpredictable world of finance and try to predict if the market is about to crash soon. Market crashes are a harsh reality that every investor and economy faces, bringing significant changes to the financial landscape. These events can be devastating, causing widespread losses and economic downturns. Understanding the signs of a potential market crash is crucial for investors to make informed decisions. Market crashes have occurred throughout history, and their impact is still felt today. The memories of the 2008 financial crisis and the more recent pandemic-induced market volatility are still fresh in many investors' minds. Investors who fail to recognize the warning signs of a market crash risk losing substantial portions of their portfolios. The importance of recognizing these signs cannot be overstated, as it allows investors to take proactive steps to protect their investments. By being aware of the potential risks, investors can adjust their strategies to mitigate losses. This knowledge can be the difference between financial security and disaster. Historically, market crashes have been preceded by warning signs that, in hindsight, seem obvious. The question is, what are these signs, and how can investors recognize them in time? The current state of the market is complex, with many factors at play. Some experts predict a crash is imminent, while others believe the market will continue to grow. The uncertainty surrounding the market makes it essential for investors to stay informed. Global events, economic data, and market trends all play a role in shaping the market's direction. Economic indicators such as GDP growth and inflation rates can provide valuable insights into the market's health. Investors closely watch these indicators, looking for any signs of weakness or instability. The market's reaction to these indicators can be unpredictable, making it challenging to forecast its future direction. Signs of a potential market crash include increased volatility, declining investor sentiment, and rising debt levels. These signs can be subtle, and investors must be vigilant to recognize them. The market's history has shown that crashes often occur when investors least expect them, making preparedness key. Investors must consider the broader economic context, including global events and political decisions, which can significantly impact the market. The interconnectedness of the global economy means that events in one region can have far-reaching consequences. Staying up to date with current events is crucial for investors to make informed decisions. As the market continues to evolve, new signs of a potential crash emerge. The rise of new technologies and investment platforms has changed the way investors interact with the market. While these innovations bring opportunities, they also introduce new risks that investors must be aware of. Investors must balance their desire for returns with the need to manage risk. This delicate balance is key to navigating the complex world of finance. By understanding the signs of a potential market crash, investors can make more informed decisions and protect their investments. The market's unpredictability is what makes it so challenging to forecast its future direction. Despite the uncertainty, investors must remain vigilant, watching for any signs of a potential crash. High debt levels, stock market volatility, and economic data are key indicators that could signal a downturn. The current debt levels of many countries are at historic highs, making them vulnerable to economic shocks. This vulnerability can have far-reaching consequences, including higher interest rates and reduced consumer spending. The stock market's volatility is another indicator that investors closely watch. Significant fluctuations in the market can be a sign of instability, making investors nervous. Economic data such as GDP growth and unemployment rates also play a crucial role in shaping the market's direction. Investors must consider the broader economic context, including global events and political decisions. The interconnectedness of the global economy means that events in one region can have far-reaching consequences. For example, trade wars between major economies can significantly impact global trade, leading to economic instability. The rise of new technologies and investment platforms has changed the way investors interact with the market. While these innovations bring opportunities, they also introduce new risks that investors must be aware of. Cryptocurrencies, for instance, have been known for their volatility, making them a high-risk investment. The most compelling evidence of a potential market crash is the combination of high debt levels, rising interest rates, and declining economic growth. This perfect storm of economic factors can create a toxic environment for investors, making a crash more likely. Investors who recognize these signs can take proactive steps to protect their investments. The alarming trend of rising national debt is a significant concern for investors. The long-term sustainability of this debt is uncertain, and its impact on the economy could be substantial. Investors must consider this factor when making investment decisions. The market's history has shown that crashes often occur when investors least expect them. The 2008 financial crisis, for example, was preceded by a period of rapid economic growth and low unemployment. Investors who recognize the signs of a potential crash can make more informed decisions and protect their investments. Key indicators such as high debt levels, stock market volatility, and economic data are crucial in understanding the market's direction. Investors must stay informed about these indicators to make informed decisions. The interconnectedness of the global economy means that events in one region can have far-reaching consequences. In conclusion, recognizing the signs of a market crash is crucial for investors. By understanding key indicators such as high debt levels, stock market volatility, and economic data, investors can make more informed decisions. The stakes are high, and investors must remain vigilant to protect their investments. The main indicators discussed, including high debt levels and stock market volatility, have significant implications for investors. By recognizing these signs, investors can take proactive steps to mitigate losses. The importance of staying informed and up to date with current events cannot be overstated. Investors must balance their desire for returns with the need to manage risk. This delicate balance is key to navigating the complex world of finance. By understanding the signs of a potential market crash, investors can make more informed decisions and protect their investments. The unpredictable nature of the market makes it essential for investors to stay informed and adapt to changing conditions. Recognizing the signs of a potential crash is crucial in this process. Let me know in the comments what you think about the signs of a market crash, and check out my other video for a deeper dive into the world of finance.